This tutorial provides a brief overview of Darwin, the asset class listed at the Darwin Exchange for the benefit of independent traders and investors. First of all, what is a Darwin? A Darwin is nothing other than a financial asset that investors may buy or sell, just like they do with a stock or a mutual fund or any other asset with which they're already familiar with. If you're curious as to what Darwin actually means, it is an acronym for Dynamic Asset and Risk-Weighted Investment, which is our evolutionary way of redescribing trading. What is a Darwin's value tied to? Well, a Darwin is nothing other than a wrapper around a trading strategy. So whenever a trading strategy, say, goes long the euro dollar, people who have bought that Darwin will replicate it and go long the euro dollar in the market. However, crucially, as they do so, the investors will ignore the underlying trade which has been taken. All they will know is the listing price of the Darwin. For instance, they will buy at a value of 117, just like they would with a stock, hoping that that liquidation value will go up if things play out as the original trader planned. So Darwin tracks strategies timing without disclosing live trades. That is the idea. A Darwin is a trading strategy with a wrapper around it so that the investor does not know the live trades that drive their investment. And the reason that this is not disclosed is that if the investor knew the live trades, he would have access to the intellectual property of the trader, and he would be in a position to replicate the profits by the trader without paying the trader for it, which provides a strong disincentive for good traders for disclosing that information. So how does the replication process work in detail? Well, on the one hand, we have the strategy, which informs the Darwin, so that whenever a strategy triggers a trade, the Darwin will take that trade on behalf of the investors. However, the fact that the trade is taken does not mean that it is taken with the same risk as the original strategy, because Darwin X takes two types of risk adjustments. The first type of adjustment is a levering and delevering process to transform the strategy into three different risk levels that investors may choose from, as we will describe later. And the second adjustment is to control for deviations from normal risk taking. So whenever a strategy takes risk which is outside of its historical parameters, Darwin X will intervene and not replicate that trade with the same risk for investors to protect them from excess risk. And those adjustments will take place both at the trade open, when the trade is obviously opened, and also throughout live trades. If for whatever reason market conditions increase in volatility and a trade remains open which represents excess risk for investors, then Darwin X will partially close that position even if the underlying strategy does not do it. And that transformed strategy is what investors buy. So it is important to note that whilst the Darwin is based on a trading strategy, it is not the same as the underlying trading strategy. And the differences between both will be the more substantial, the worse the risk management by the original trading strategy is. It can come in many cases that strategies which register bad profits, i.e. losses on their own account, actually deliver profit-making Darwins because the risk adjustments improve the strategy to make a losing strategy owing to bad risk management a winning strategy. And this is one of the reasons why you have talented strategies in the Darwin X leaderboard which seem to be loss-making, but whose Darwins actually represent an incredible profit opportunity for investors. So how risky are Darwins? Well, Darwins come in three different risk flavors. Each Darwin is demultiplied into a low risk, a medium risk, and a high risk version with 4, 8, and 16% of value at risk. To give you an idea of what those value at risks represent, a 4% value at risk would be about half the risk of a large equity index like the S&P 500 on a monthly basis. And a 16% value at risk would be about as risky as investing in one of the more volatile stocks in such indices. Investors choose between Darwins using the Darwin-X diagnostic algorithms. As you know, these rate all strategies for their investor appeal. Currently, there are 6 investable attributes that Darwin-X rates, which are experience, risk management, discipline, performance, timing, and scalability. Each of those is graded with a grade from 0 to 10, which is then weighted into an overall D score or Darwin-X score that ranges from 0, which is pretty bad, to 100, which no one has achieved to date, which is very good. In other words, the algorithms rate the Darwins for investor appeal. That's why the competition is called Darwinia. And investors are free to choose using the algorithms as they see fit. We do not claim to know better than investors how to use our own algorithms, and that's why we disclose all the information so that everyone is free to make his own decisions. So what do Darwins cost investors? Well, as the investors replicate the Darwins, they will pay 20% of the profits they obtain on each Darwin in every quarter. Darwin-X will have attracted those investors, will comply with regulatory requirements, provide the technology platform, the middle office in terms of rating the strategies and adjusting the risk, and the back office to do all these calculations, and passes on 15% of the profits, i.e. 75% of what it collects from the investors to reward the traders for the intellectual property that they contribute into the Darwin. The Darwin listing price includes the 20% success fee and the execution fees required to replicate the Darwin. Marketing and buying Darwins is legal because, as you may or may not know, Darwin-X is regulated by the Financial Conduct Authority in the UK as both a 100% STP broker and an asset manager. So whenever Darwin-X sells the Darwins to investors, investors enjoy the MiFID protection that European regulation affords them. And importantly, all the trader is doing is providing some market information to Darwin-X, which essentially means he is not engaging in a regulated activity. He does not require regulatory permission because he is enjoying the regulatory cover that Darwin-X regulation affords him. So informing Darwins and investing in them is FCA UK regulated and 100% legal. Investors can build Darwin portfolios. This is the reason why Darwins come in fixed risk levels. All the investors do is essentially purchase whatever versions of Darwins they want. As they do so, they build up their trolley of risk, and then they watch how the risk they have taken delivers returns, and they can monitor those returns real time and enter and close a Darwin anytime with immediate liquidity, which makes it easy and actually fun to build and trade Darwin portfolios. So enough talk. We've talked about the thing. It's probably better to actually see the real thing in action. So let's go into the Darwin platform to show you how this works in practice. So this is the Darwin leaderboard in which we can see currently displayed 2 different Darwins corresponding to 2 different strategies. For each Darwin, we list the investable attributes for the particular underlying strategy, namely experience, risk management, discipline, performance, timing, and scalability, all of them graded from 0 to 10, and summarized in a weighted average score, which we call Darwin-X score, which goes from 0, which is bad, to 100, which is pretty good and no one has ever achieved to date. As we mentioned before, Darwins are available in 3 different versions, the low risk, high risk, high risk and very high risk. So we can check out the returns for the low version, move to the high risk version and the very high risk version. And as you see, the investable attributes have not changed, but the return and drawdown patterns change according to the risk profile. If we wanted to look further into one of the individual Darwins, all we do is go in here to see their Darwin profile. We see here that this is the JKJ Darwin on its high risk version. We can see all these different variations. It is based on the Bogoha 1 strategy, And for this Darwin, we know how many investors are currently tracking it, which is obviously none because we're still in demo. The return it has achieved, the risk it currently has in the last year, and the worst drawdown experienced, alongside the investable attributes, and a number of useful criteria. You see, meanwhile, that every 30 seconds the price is changing because it's being updated as the market moves. We could see the evolution for the last day or maybe for the last month if we wanted. Again, it has changed. We could see the risk return profile for the Darwin in terms of daily distribution of returns or the weekly distribution of returns. We would have some basic data around the activity of this Darwin, around what times of day it actually trades, as we can see here. We could see what assets it trades the most often, and we can even see the daily performance from on the different weekdays. So this particular Darwin seems to do pretty well on Mondays and somehow well on Thursdays, but this seems to indicate to stay away from it on Tuesday, Wednesdays, and Fridays. And very importantly, we can get a feeling as to how closely this Darwin tracks the original strategy by having a look at the evolution of the Darwin itself, plotted here in white, against the evolution of the underlying strategy plotted here in blue. And we can see that whenever there are extreme movements in the underlying strategy, the Darwin's risk adjustment, which is what we're looking at, will mitigate those to deliver an investment with the value at risk that the investor desired. Obviously, as we mentioned, a Darwin is an asset. Right now it's listing at 86.25. If I wanted to buy the high risk version, all I would do would be to trade, choose to buy, choose for how much to buy, and get out of it. And that's essentially how a Darwin works. So if you're curious about how to market your intellectual property to investors, well, all you need to do is link your existing MT4 or CTrader account to Darwinia. That will allow you to import your existing track record to DarwinX so that you don't have to start from scratch. And you can fund your real account from an amount of $500 US. That is to say, you could maybe start with a test account to verify that our execution conditions are really amazing. And of course, you would then have to grant us permission to transform your strategy into a Darwin, because the last thing we would do would be to market your intellectual property without your permission. That was it. Hopefully this tutorial clarified what Darwin is. If you want to know how strategies are assessed, you can go into this Darwinia link, which will provide you with a YouTube tutorial to do it, or you can just generally visit our YouTube channel, which explains most of the concepts to do with Darwinia. This was Juan, co-founder and CEO of DarwinX. Thank you for your time watching this video. If you have any questions, please reach out to us through our website, and we look forward to your feedback. Thank you so much. Take care.